Hello and good afternoon. Thanks for joining today's Market Color webinar. Before Jordi shares his thoughts, we would like to share our compliance department's thoughts, which are as follows. Weiss does not recommend any particular stocks, bonds, options, derivatives, or securities of any kind. We do not guarantee any results or investment returns based on the information you receive. Although we have used our best efforts to provide the most innovative trading and investment strategies, the views presented today are forward-looking statements which are subject to change as circumstances change, and we cannot promise future profitability. If you have any follow-up questions after listening to the webinar, please feel free to reach out to Jordi and/or the marketing team. Weiss would love to hear from you. A replay of this webinar will also be available on the Weiss website and YouTube channel later today. And with that, Jordi, the floor is yours.
Thanks, Leah, and hi, everyone. I waited until after the election to kind of give some views on things, partly as an update, but I think more importantly, based on the conversations I've had this week, just some thoughts on where I think the opportunity is coming out. The one thing I want to say going into this is that presidential elections in the United States can have meaningful changes to what's been working recently. And I think a lot of the conversations that have happened have been so far around whether, what has worked the last 4 years is going to continue to work or what's not. And what I want to take you through right now is some areas where I see both opportunities, but also kind of give some views on what I think the most important point coming out of the election is. So first of all, let's just go through, since I last did one of these in September, what's been going on. The PMIs made new highs, so we continue to see strength in the economy, as this chart shows. At the same time, revisions continue. The earnings period in the US has been very strong again, and globally it's been strong. This is the Global Revisions Index, which continues to move higher. At the same time, we have not seen money supply come down in the United States. So you still have this is a year-over-year number. At some point, you would expect to see something similar to what we saw back in 09, which is at peak and then start to sharply come down. Currently, we're about 8 months or 7 months off when M2 really exploded. That would take us back to here in 09, somewhere around the November period, where we had already fallen off. In the US right now, money supply has not come down, and I think it's an important point for people to continue to have in the back of their mind as they worry about things. In terms of where the spending goes, we had, again, another PCE spending number, and the durable side continues to be the story. So this is just an update on the expenditures for durables, which is the white line, which continues to go higher, and then the services, which continue to be impacted by COVID. So assuming COVID is going to remain something, rather than focus on the stories about lockdowns, I think you have to continue to believe and go through it. The event that occurred back in March is not going to happen again, and the expenditures that are happening on the durable side will continue at the expense of the service side, and that's continuing. That's what we're continuing to see. When you go through in the guts of it, just again to highlight, this is the ratio of durables to services making a new high. So everyone's been kind of looking for when services would pick back up, and this was a temporary thing. I still do not believe this is temporary. I think this is a behavioral shift. This is the PCE motor vehicle numbers continuing to go higher. So you have expenditures going higher, and you've seen the inventories, they continue to draw down. This is going to remain a story. Inventories will be a story for the first half of next year for sure. And this is the 6-month rate of change of new home sales going back to 1990. So you continue to see housing and automobiles that are driving things. I wanted to give you guys just a sense as to the dollars we're talking about. So the next chart, the orange line again is the PCE durable number, so you can see that blowing out to the highs. The white line is one that I created, which I'm calling the PCE for experiences. And as I've said before, if you really think about a shift from experiential spending into good spending and the impact that that has on so many parts of the marketplace, from a commodity perspective, from an inventory perspective, from a trade perspective, the experiential side, which includes restaurants, hotels, casinos, live entertainment, transportation via airlines, all that stuff, you see the drop off we've seen since COVID, which is from 1.3 trillion down to 1.5 trillion or 1.05 trillion. So you're talking about $280 billion of a drop. At the same time, the durable side has gone up by about 210 billion. So for everyone worried about what's been happening on this side, we've seen it here. If I add in the food at home, you're going to see an even bigger explosion up here, meaning the replacement of the restaurants has just been more spending at home for food as opposed to out. So the experiential side has not taken down the economy, and I think regardless of COVID, it will not do it as long as income growth is still there. And I'm not going to bring it up, but last month we did have the income numbers come out. And again, this relationship between the PCE durables and the S&P is one of the more important things that suggests that you should be paying attention to the multiplier effect on the durable side rather than get too caught up on what's happening on the service side. And then finally, getting back to that inventory side, this is the new orders less inventories inside the PMI. The most recent data, we continue to be up at high levels, basically at the highs of the last 10 years. And what this argues is that we still haven't reached a point yet where inventories have picked up. And that means there's a lot of growth coming in the first half of the year, regardless of what the stimulus size is or not. The white line here is the percentage the S&P is above its 200-day moving average. It's currently at 12.5% above its 200-day moving average. I think this thing is going to continue to be around these levels until we start to see new orders match up with inventories. And I don't expect that to happen for the very near term. I think you're going to have a lot of inventory build, and I think there's a lot of places in the economy that you're going to continue to see strength. The one thing that still stands out as an update, and most people are familiar with it, but this is the new orders, the orange line, the revisions on a global basis, the white line, and this is 10-year rates. So as we go into this, I want everyone to remember that when we kind of, in this period here, I'm going to show a lot of charts now where I'm highlighting the election back in 2016 when Donald Trump surprised and what was going on. We had we were coming out of a commodity fall in 2016. We had rates on the lower end, and then all of a sudden we started to see kind of a cyclical move higher and everything, and you saw the benefits. In 2017, it continued as the tax cuts came through, and then when I started talking about 2018, this is really when the change happened. The Fed was obviously done raising rates in the fourth quarter of 18, but really more importantly, we started to see all the economic numbers pull down on the back of the trade side. And that's where this conversation on the election will become important, because you're looking for shifting themes that'll go. The other point I want to bring out, and I took this chart back to the end of 16, this is the white line here is the total debt that is negative yielding in the globe now. We're currently at $16.7 trillion. This is inverted. At the same time, there's about 85% of all global bonds are now yielding less than 2%. The estimates on that are about $50 trillion are yielding less than 2%. The reason that's important is because we went into the last election, we did not have that scenario. So when you're trying to set a framework where right now we have the economy getting better, we have revisions going higher, but we have rates pinned at lower levels, there's a lot of cash out there. Forget what the government needs and what the stimulus numbers you're hearing about. I don't care whether it's $1 trillion or $2 trillion. There are trillions upon trillions of dollars globally, which is sitting in close to zero yielding instruments that did not exist in 2016. And there's been a big change that's going to happen. And that's the thing I want to talk about kind of as we segue into the election. And that's where I'm going to start this. This is a chart, the white line here is the 6-month contract of the VIX futures sitting up at these levels. The orange line down here is the BBB spreads. So BBB bonds, IG bonds are now yielding, the spreads have come in sharply. Vol has not come in sharply. I'm going to, just accept the fact that Donald Trump's names or monikers that he gives his rivals have some semblance of reality for him to them. In the case of Sleepy Joe as this one, I think you should all think about Sleepy Joe in the context of moving from where overnight Twitter bombs around the globalization side were happening and going into something where if the Sleepy Joe moniker has any truth to it, and you believe it does, I fully expect volatility to come down sharply relative to the last 4 years. The volatility moving down has huge implications for a lot of assets, and that's what I'm going to talk about, because a lot of the factors that have worked, in my opinion, have been about avoiding the uncertainty over global growth, over global trade, over volatility overnight. And I think it's led to safety, which has been really in quality companies and growth companies, and it's been out of value. And so if you're looking for some kind of change, I think long-term volatility will start to come down sharply as people worry less about those things. And this assumes, obviously, that Joe Biden does win. I don't really care what happens in the Senate at this point. You guys can call me on that if you want to talk about it offline. But I think the most important story for this thing is what happens at the White House level for what's going on for a lot of the things that I'm going to show. Now, in this case here, we've got those BBB spreads again. This is the emerging market bond index spreads, which have also come down. And then you've got volatility here. There's a linkage to volatility and a lot of these places around the globe that are out on the risk curve. And I think they're important for allocators to make decisions, particularly when they're pinned at a point where rates are at zero. Again, here's 10-year yields that are down here. Volatility is up here. I have a derivative background, and to believe that the 1-year S&P call option can get you about 8% if you sell it right now, versus being long the S&P and being able to get an 8% coupon when yields are down here. Traditionally, you would expect to see longer term people come in and start doing overwrite strategies. I absolutely believe we're going to see vol come down as we go through and get completely out of the election. So I would watch that ratio. This is where I wanted to really start to bring up the story that to me is the most important. In October of 2016, I attended the IMF meetings. During the IMF meetings, the #1 topic of conversation was if Donald Trump won, which obviously at that point was a very, very low likelihood. All of the people attending the IMF meetings, the presenters, the pension funds I spoke with, believe that if that were the case, the #1 thing that would suffer would be emerging markets. It would be a deglobalization event. The thoughts he had on trade would be very, very difficult for the world to kind of have certainty in the long term. And so it would shrink the ability to make long-term investments and make long-term decisions. This white line here is basically a year after the election and right before the trade side actually went in. And this chart here is the PMI. This is the yellow line for the US, and then the white line is the year-over-year or 10-month average of global trade. So what you can see here is right when the first tariffs started to come in, or we got into the point where the tariffs became the focus coming out of the tax side, you had a drop in both the PMIs and global trade. That was what was expected as we ended 2016, but it didn't go into place until 18. To show how important this is, and I think why it's an inflection point, this is what the ADXY, the Asian Dollar Index, was doing for 2015. And I think people forget when Donald Trump did win the election in here, we had already been having a weak period in terms of Asian currencies. It was the hangover effect left from the commodity fall that had gone on. You had a lot of situations that were bad. So when these IMF meetings occurred here, there was already a negative feeling to some degree on the on emerging markets, but in particular, it was fears over if you added post the commodity situation, this problem, you've had the currencies that would continue to go down. And what ended up happening, obviously, Donald Trump wins. Currencies keep going. We get the boom on the back of the tax situation. Then the tariffs start going into place at the end of March. And from that period, we see things down. Now, the Asian dollar index is trading higher going into this election. So a different scenario than what we saw back here. You have it already rising going in, and you can see that even post the election, we're seeing a breakout here. So little different story on this one. And I think part of it is the belief that the trade situation will improve going forward. To confirm that, we have a chart I've shown you before, which is the cyclicals versus defense overlaid with ADXY. That continues to move higher. At the same time, to make it even a tighter fit, going back to 2009, this is combining the Asian dollar index with commodities. This is a CRB spot, industrial spot index. So that's going higher. It's breaking out again. So we continue to see post the election, no matter what has happened, whether people were worried about a blue wave sweep or they thought we'd be with a Republican Senate, you've seen the cyclicals versus defense continue to move higher. And again, this is that cyclicals versus defense versus the PMI, which is still up at high levels, suggesting that you should expect the industrial side to continue. And with rates pinned at low levels, initially this had been a drag. People were worried that COVID was keeping this down. I think now there's been an acceptance that when the Fed effectively went to, hey, rates are pinned, we're going towards inflation targeting. This is a new world coming into this where we're going to let inflation run higher. And I think it has big implications with rates down at not only pinned down there, but with global yields below 2% at $50 trillion. This is just highlighting now as we go into this, my belief in emerging markets. So for those of you who don't know, I was involved in emerging markets at Morgan Stanley for the bulk of my career. I lived in Brazil for 2 years. It is my single best thought coming out of this is that people are underestimating emerging markets. It has huge implications for the value versus growth trade. Emerging markets need to have a long-term thought process. I think the trade situation had a huge impact for them. And as I go through these charts, I just want to make sure you realize there's a lot of things happening in emerging markets with a lot of dollars existing that are going to be looking for yield. And right now we still have, this is the emerging market bond index yield is at 5%. When we came out of the election with Donald Trump, we were right around 5%. This yield here is the triple B yield index in the US, which is now down at 290. And post the election, it was about 4%. So you're getting the same yield on emerging markets right now while you're getting a lower yield on the triple B market. And I think that's where the emerging markets are going to start to draw in money. There is a yield threshold that people want. To show the importance of these the emerging market yields, the white line is the ratio between, it's the spread between the yields. So emerging markets are currently about 214 basis points above where the triple B is. This is it overlaid with the 6-month contract of the VIX. So you can see that as vol comes down, you will see more people get more comfortable, or at least historically, with emerging markets. In terms of that white line here, that's that same chart. It's the spread between emerging markets and triple B bonds. This time what you have, and this is the most important part of the emerging market story, it's the currency side. So this is the JP Morgan EM spot index inverted. So we've seen so far that we made a low in emerging market currencies back here around COVID. It's been kind of consolidating here. I fully expect the currency side for emerging markets to be the single best trade for the next 14 months. I like it versus the dollar. I like pretty much all currencies versus the dollar, but I in particular like the emerging market story as I go through this. One of the reasons is that the lag that's been happening has been, again, we've broken this linkage between the ADXY and the CRB2. I think with the election out of the way, this will start to bring more money, particularly into the end of the year as people look for a home to where to get some more risk. I think emerging markets are going to benefit. Again, just to show you the EEM over S&P relationship to the ADXY, EEM over the S&P, so the emerging market ETF relative to the S&P, which has a long-term correlation to value as well versus growth. You can see that it's starting to trade better a little bit, made the lows in the March COVID, but it has lagged behind the ADXY. And again, you see the setup here. Right here is where Donald Trump won. Emerging markets get hurt, just like everyone expected at the IMF meetings because of the trade side. That was a good call. And I think coming out of this, you have to look at it the other side, that the number one story for emerging markets is a little more certainty over the relationships between the United States and China and emerging markets. This is that ADX CRB2 index that I created, again with EEM to the S&P, so suggesting that you're going to come higher in emerging markets relative to the S&P. This is Brazil. So the white line here is Brazil spreads on the sovereign side, basically making new tights after the election, which I think is a very good sign. This is the Brazilian real up here. I expect the real to be one of the best performing currencies over the course of the next year. If you go look at the PMI numbers in Brazil right now, they're up around 67. So you've already seen a sharp move there. This is one that I highlighted a couple months ago, but I want to make sure you see it. This is the EMQQ, which is the NASDAQ kind of EM ETF, trading directly in line with the EEM until we get to COVID. So this is a normalized thing. So this is back to November of 17. They were basically right around the same performance. And then since then, we've seen, because of the rise in China, we've seen this EMQQ driven by Tencent, Alibaba, things along those lines going higher. The one thing I would point out is EEM this week has made an 18-month high. So EEM is going higher and you're starting to get this move. I think this is going to continue. And I think this is just another reason why you're going to start to see it move higher. This is EWZ relative to the S&P. If I had to pick one ETF at this point, and again, I've talked about Brazil, I think between the currency and the equity markets in Brazil, you're going to see a sharp outperformance to the S&P. And in my history, this thing can move a lot more than people realize. So I think there's going to be a significant change in this. That is overlaid with the emerging market spreads, the white line. So as spreads are tightening, you would expect to see emerging EWZ outperform the S&P. Hasn't occurred yet, but I think it will. Just a couple charts left. This is one thing I just want to highlight in terms of the relationship between all of these things and how much we're seeing the currencies lag behind. So the green line here is emerging market spreads. Inverted, so you can see that the spreads are tightening. You can see the relationship between the white line, which is EEM over time. The orange line is the currencies, so it's lagging behind. And then the purple line is the ADXY CRB2. So we're really seeing a lag here in the currencies that's not following the other ones that are going on. What I drew in the line here, this is this peak here, they all went down together. This was really when crude started to fall. The bottom here, they all bottomed together. This is when crude started to bottom. This peak here, again, is when the trade tariffs started to go into place. You started to see all of them go down, and then the lows here are at the COVID lows. So they traditionally moved together, and they had that linkage had been there. This time we haven't seen it. I think this is a lag effect, and I think the election is going to be the cause to start to see the currencies pick up, and that would be a big thing and a great opportunity for people looking to invest in emerging markets at this point. When the currencies are going, you get a huge impact. And this is the final chart. This is really just to show you the importance of the election. So this is the factors of quality, growth, and value over the last 10 years. This line here is when the election occurred. So when the election occurs and we start having more volatility, we have less certainty on globalization, we start putting every single company into something related to, are they impacted by trade? Are they impacted by globalization? Or are they going to be fine during this? And you start seeing quality outperform. This is into COVID. And then the orange line is growth. This is value. So before that, we had no trending really going on in this. You'd see cycles, but it would go up and down. We've seen a very strong trend between the growth, value, and quality side that began with the election. So I think everyone should be looking at this election as more of a turning point in the fact that if you've had cash saved up, if you're a private equity company and you have loads of cash, if you're Warren Buffett and you have loads of cash, if you're a pension fund that has now watched yields go down significantly from where it was, not only in 2016, but where it was at the end of 2019, and now you have rates pegged, where are you going to move your money and what's going to happen? I don't think quality and safety is going to work coming out of the election. So one of the reasons why the growth versus value, in my opinion, did not do what it normally does coming out of a recession, which would have been in March, is because of fears over the election. And I think the election outcome argues strongly for lower volatility, at least an end to the deglobalization trend. I don't expect to see a change in tariffs and things like that, but I also don't expect to see escalations and things happening suddenly overnight. So long-term businesses can make decisions, M&A can pick up again, and I think that has huge implications for valuation as a factor, and I think it has huge implications for emerging markets. So a little longer today, but I thought post-election it was important to get things out. I do believe the equity markets and the pro-risk stance make sense, and that we'll continue to see higher levels, at least going into the end of the first quarter. And if we do end up in a situation where we have a Republican Senate and Joe Biden is president, I do believe that that is the best outcome for a lower vol, steady return profile for at least the next 6 to 9 months until we start getting into what the economy is actually doing once inventories have been built back up. That's it for me today. Look forward to speaking to any of you on any of these comments, and I'll come back at some point in the near future.
That concludes today's webinar. Thanks for watching.